Good morning. In this lesson on corporate real estate due diligence in mergers and acquisitions, we will review the objectives of corporate M&A and the most common transaction structures, and then the relevance of real estate due diligence during the M&A process. How should corporate real estate asset managers proceed to evaluate the strategic alignment of the real estate portfolio to be integrated into the new organization, and thus decide which properties to divest? And finally, what are the main real estate risks we should focus on? The M&A activities require a long process in 5 stages. The overall due diligence is conducted during the second stage, and the corporate real estate is a part of it. In almost every mergers and acquisition transactions, the purchaser will acquire an ownership or leasehold interest in at least one real estate asset. However, the real estate assets do not drive a typical M&A transaction. Although it is often neglected during the M&A due diligence process, real estate can play a pivotal role in M&A success. Let us look at the reasons behind the corporate merger and acquisitions. It could be for reducing competition, for establishing a larger share in the market, for developing a powerful brand name, for minimizing tax liabilities, for diversifying risk, and also it could be for setting off losses of one entity with the profit of another entity. In most cases, a particular real estate asset will only have significance because of how it will be used in the purchaser's business operations after closing. Sometimes the real estate may only have incidental value in the big picture. If real estate is not driving the transaction, the purchaser may be inclined to undertake, substantially limit, or simply postpone the real estate due diligence. Each M&A transaction is different. It requires a unique real estate due diligence plan. Never one size fits all. It is influenced by a variety of factors. Typically, the most significant factor is the relative importance of the real estate in the context of the overall transaction. The real estate due diligence process varies depending upon how the M&A transaction is structured. At the outset, make sure you completely understand the applicable transaction structure. 3 most common M&A structures are asset purchase, stock purchase, and merger. In an asset purchase, the purchaser acquires all or a portion of the seller's assets. Unless successor liability is imposed pursuant to the applicable laws, the purchaser is only liable for those obligations of the seller, if any, that the purchaser expressly assumes under the transaction documents. In stock purchase, the purchaser acquires all the ownership interests in the target company. Target company's assets and liabilities remain the same. In some cases, the M&A process in share deal may require few successive structure and steps until the final scheme. In mergers, two or more companies are combined. The surviving company succeeds to all assets and liabilities of the disappearing companies. It could be horizontal merger, vertical merger, conglomerate merger, market extension merger, or congeneric product extension merger. Let's see some example on the mergers. The first case is the acquirer company and the target company came together to create a merged company. This is the case between Disney and the Hotstar that became Disney Hotstar in India. In the second example, two companies, one from upmarket and other one from the down market, they merge to become vertically integrated companies. In this third example, two companies from different industries could merge to form a new company in the new industry. For example, between hardware company and the software company, they merge to produce smartphones. When many individual companies merge, they create a new conglomerate company. Congeneric merger is a type of merger where two companies are in the same or related industries or markets but do not offer the same product. Initially in construction sector, Bouygues Group is an example of conglomerate mergers that group different activities such as construction, energy and services, media, and telecom. Let's look at the case of the BBC. The BBC is a vertically integrated company. Vertically integrated companies are a group that all produce different products and services but share a common owner. They all combine for a common need. Depending on the circumstances, you may be asked to evaluate the relative importance of the real estate in the context of the overall transaction. Therefore, it is important to understand what due diligence might be required for the real estate assets involved in the transactions and the potential risk of not performing that due diligence. Main issues to be addressed in the due diligence process on real estate assets. First one, asset discovery. Check inaccurate portfolio baseline value and cost. Secondly, asset risk. Look at lease terms, environmental issues and market factors that may present future increases in occupancy cost and risk that may limit portfolio flexibility. Third one, redundancy. See locations within close proximity to one another that could be prime candidates for consolidation. Business alignment. It mainly concerns portfolio alignment with changing customer dynamics, advancing technology's impact on operations, and future talent needs. The fifth one is about integration. What are the costs and degree of difficulty to execute the integration plan? And the last one is about divestment. What are the hidden costs and value associated with divestment? We must focus our due diligence process on the following objectives: understand M&A intent, optimize portfolio to drive value, perform full risk assessment, develop clear performance measures. How this building is compliant with our sustainability metrics and with our corporate social responsibility. If its position is relevant to our business and activities, how it may allow us to execute our company mission and strategy. Should we become the owner, remain as tenant, or proceed to sale and leaseback? Where is it located? Is it aligned with our company culture and values? How our operations will be impacted? How it will contribute to our people well-being? In order to ensure successful integration planning and execution, because our performance and productivity depend on it. Corporate real estate asset managers, in collaboration with the operational divisions, should integrate, direct, and support the strategic alignment of all business process and underlying business assets, including human capital, with land, buildings, and working environments of the organization. Therefore, you should focus on strategic alignment of these 8 principal components to assess the portfolio impact upon the performance and the productivity. Then, evaluate integration costs and difficulties of the portfolio into the new organization, and thus decide which properties to divest. Planet component emphasizes the growing significance of sustainability and the health and well-being benefits that can flow from a sustainable solution, not only the corporate social responsibility and cost-reducing financial aspects. Position. This component relates to the position of the organization in the business environment relative to its competitors. In addition, it can also relate to the position of the organization in the business cycle. An expanding organization has different requirements to a restructuring or contracting organization. Purpose relates to the business aims and objectives. This may include the company mission or vision statement and aims to establish the future direction of the business. The working environments must be aligned to suit the purpose of the organization, which may include producing goods or services of the highest quality, which can only be delivered by an engaged and motivated workforce, comfortable, supported, and inspired by their working environment. Procurement relates to the way the organization's working environments are acquired, financed, and managed. It will involve seeking the right balance and the type of owned and leased premises, and a strategic understanding of the impact of the real estate has on the balance sheet and P&L account. Security, business continuity, flexibility, and management of change will also be a function of the procurement strategy. Place has external and internal components. The external component relates to where the building is physically located. The internal component relates to the building and office environment layout created. A paradigm is a working model. It is the typical assumed way that we go about our lives or a certain area of our lives. Paradigms encompass thought patterns, beliefs, and behaviors. They impact how we do things, what we believe is right, and set standards that most people generally agree on. These are the unspoken rules. Paradigm relates to the organizational culture or organizational DNA. It is important to establish how the organization works and understand its beliefs and values. It is also important to establish microcultures, the way that people work in the office environment. This could be the workplace DNA. There are many processes in the organization, and the activities of an organization have several different levels. At one level, this includes the interrelations between the different departments in the organization. At another level, this relates to the specific work processes undertaken by the individuals in an office environment. Understanding the office environment from the occupier perspective is a central principle to the alignment. This could be developed to include personality types and team role types. When these 8 components are strategically aligned, they can produce tangible and measurable benefits in terms of two strategic outputs: performance and productivity. Performance could include traditional efficiency measures of property performance, but will also include hybrid measures of business and property performance, such as revenue per square meter or profit per square meter. Since office environments are experienced through all our senses, it seems appropriate to develop ways to assess how the office environment affects these senses. Productivity could include individual and team-based measures. Productivity measures may be directly linked to business performance, self-assessed measures, or a combination of the two. They can include more cross-selling and creative ideas through increased connectivity, increased customer dwell time, increased customer satisfaction, reduced absenteeism due to the illness, reduced staff turnover and increased engagement, motivation, and creativity. By proceeding real estate due diligence, the parties can identify the real estate risks that arise in the decision-making process, modify the deal structure to mitigate real estate issues, account for the diligence items requiring significant lead time to make sure the transaction closes on time, and finally, identify the potential costs required for a successful closing. At the outset of the due diligence process, it is important to inventory all the properties included in the transaction, confirm those that are owned versus those that are leased, and request any related documentation for each property. This should take place during the early stages of the transaction in conjunction with the preliminary negotiations of a term sheet and well in advance of the negotiations. Due diligence on risk can then be broken down into 6 main categories: title review, survey and zoning, lease review, environmental review, transfer taxes, and representations and warranties. Title review is done by the title company whose mission is similar to notary office in France. In order to make sure the target company is the actual owner of their properties and ensure no restrictions or unpaid liens on the property by lenders. You should also check coverage risk and exclusions by the title insurance and insured amount. Does coverage apply under existing title policy after closing? And also check the title policy rates and fees. Survey and zoning. Obtaining updated reports may be well worth if the deal includes property headquarters, specialized facilities like power plants or specialized manufacturing facilities, and recently completed significant construction on the property. Surveys show access drives, boundary lines, easements, and encroachments. Updated reports usually required by the title companies to issue title insurance. Zoning reports disclose whether the use of the property is permitted in the zoning district, whether any nonconformities exist and if such nonconformities are legally nonconforming, whether any rebuild restriction exists if there is a casualty event, and whether there are any open zoning, building, or fire code violations. Lease review. Ensure that your due diligence is prioritized for any headquarter leases or other critical leases that are material to the business operations. Rent escalations, termination date, security deposits and guarantee agreement, renewal and termination rights, assignability, and purchase option. The environmental condition of real property may present major economic risks. Although a seller provides representations and warranties regarding the presence of hazardous materials or any current violations of environmental law, the purchaser should alleviate any issues by obtaining a Phase 1 environmental site assessment report. It may also be required by the lender financing the transaction. The Phase 1 report may take weeks to complete but should reveal any environmental risks posed by the property, such as old storage tanks from previous uses of the property or spills of hazardous materials. If these issues are present, the purchaser may order a Phase 2 environmental report, which is much more invasive, much more expensive, and take much more time. Cleanup required to restore the property, which should be accounted for in the transaction cost, and may provide the purchaser with the leverage to negotiate the ultimate purchase price of a deal. Environmental liabilities. In asset deals, the purchaser will not qualify for any liability exemptions unless it obtains a current Phase 1 assessment meeting the standards of the statute. In a stock transaction, the purchaser will automatically succeed to all of the target's environmental liabilities, including those related to the target's prior operations and real estate assets, as well as off-site disposal facilities to which the target sent hazardous substances. Accordingly, the environmental diligence in a stock transaction is typically more complex and larger in scope. Environmental problems and liabilities relate not only to owned properties, but also to leased properties. A ground lease property should receive the same scope of environmental diligence as would a comparable owned property. The extent of environmental diligence performed for other leased properties will depend on a variety of factors, including the lease term and the size and use of the leased premises. Now, let's talk about transfer taxes. Real estate transfer taxes is an essential component of the real estate diligence. Tax exposure may be material to the purchaser pricing decision, particularly in jurisdictions with high transfer tax rates. Modifications to the deal structure may reduce or eliminate certain transfer taxes that will otherwise apply. The parties can negotiate who will pay the transfer tax and/or allocate a portion of the purchase price to the applicable real estate. First, the market value of the asset is calculated, and then the percentage of the transfer tax as per jurisdiction is calculated and added on. The asset is transferred after including the tax to the cost of transfer. On this table, you may see different transfer tax rates applied in different European countries. The seller normally provides to the buyer a list of representations and warranties in the purchase agreement to make sure that the purchaser is obtaining the proper due diligence materials by having the seller certify to certain items, to obtain disclosures from the seller regarding what they know about the condition of the property and any title issues or violations of applicable law. These representations and warranties are required to be true as of the execution of the agreement through the closing date and sometimes beyond. A bring down certificate attests to the following on behalf of the selling business. The seller has not entered into any other agreement. The assets are free and clear to be sold. The seller is authorized to sell the assets. No changes have been made to the selling business. The selling business has not broken any laws. The shareholders have authorized the sale, and there are no taxes owing. Thanks for watching this video. For any question or more information on this topic, you may contact me by email. Please do not hesitate to send me any comments you may have or suggest improvements or corrections to the content.